I want you to imagine, just for a second, taking your actual crypto wallet and handing it over to an artificial intelligence.
Right.
Like giving it a few basic ground rules and then just walking away for 3 weeks. And I mean real money here.
Wow.
Yeah, no takebacks, no emergency brake you can pull, no manual overrides. You just let it trade in the wild.
It is a terrifying proposition for most people. I mean, giving up that level of agency goes against basically every financial survival instinct we have.
Terrifying is honestly the perfect word. But, that scenario is the reality of the source material we are unpacking today.
Exactly.
We are doing a deep dive into this, frankly, mind-blowing paper from the DX Research Group. It's titled Operating Layer Controls for On-Chain Language Model Agents Under Real Capital.
Such a technical title for something so wild.
Right, and our mission today is to explore the results of this massive live experiment that they ran called DX Terminal Pro.
And what is genuinely fascinating here is that the goal of the researchers wasn't just to, see if the AI could make a profit.
Right, that wasn't the point.
No, we are looking at this to understand why teaching an AI to handle capital isn't actually about making the AI's brain smarter. It's entirely about how you build the system around that brain.
Which they call the operating layer.
Exactly, the operating layer.
Well, the scale of this infrastructure alone is just staggering. I mean, we are talking about 3,505 user-funded AI agents.
A massive deployment.
Huge. And they traded real Ethereum on the open decentralized market. So, to be clear to you listening, this was not some paper trading simulation.
No, absolutely not.
We're looking at $20 million in actual volume here, 7.5 million agent invocations, and a 99.9% settlement success rate for valid transactions.
Which is just incredible. And really, it represents a fundamental turning point in how we measure artificial intelligence.
How so?
Well, if we zoom out to the broader landscape, most AI models today are evaluated in these pristine text-based simulations. They take a standardized test or they write some Python code.
Right, the typical benchmarks.
Yeah, or they play a simulated stock market game where the money isn't real. And, in finance, a simulation is basically a video game.
Right, there's no real risk.
Exactly. There are no real consequences if you lose. But DX Terminal Pro introduced actual market feedback. It had rapidly depleted resources, irreversible settlement. It essentially dragged AI evaluation out of the laboratory.
And right into the unforgiving world of real financial consequences.
Precisely.
The scale of that is amazing, but what truly separates this from a standard benchmark is the friction of that real world.
Oh, absolutely. The friction is everything.
Let's talk about the arena these bots were thrown into.
Yeah.
Because the users, the humans listening to this who might actually put their money in, had a very specific, limited role. And it definitely wasn't day trading.
No, not at all. The humans were entirely locked out of the execution phase.
They just watched.
Basically, yeah. The setup required users to fund these digital vaults with real Ethereum. And to configure their strategies, they used this retro 8-bit Fox user interface.
Which is hilarious.
It looked playful, right? Yeah. But underneath, users were setting serious parameters. They had these sliders they could adjust from 1 to 5.
To control what, exactly?
Things like trading activity, trade size, and asset risk preference. Or, alternatively, they could just type out natural language strategies for the bot to interpret.
I just love that psychological contrast.
Yeah.
You are using an interface that looks like, a 1990s Super Nintendo game to manage tens of thousands of dollars of real Ethereum.
It's very surreal.
It is. But once those settings were locked in, the human was entirely hands-off. Only the AI agents could actually pull the trigger.
And just to be specific on the tech, all 3,505 agents were powered by the exact same model.
Right, the Quinn model.
Yes, a massive one called Qwen 235B A22B Thinking 2507.
That is quite the name.
It is, yeah. And they were operating in a bounded universe of 12 different tokens on a decentralized exchange called Uniswap v4.
Okay, so the crucial detail here that makes this a true crucible for the AI is the friction we mentioned earlier. Every single trade had a 2.3% fee attached to it.
Which is incredibly high for high-frequency trading.
It really is. That breaks down into a 2% protocol fee and a 0.3% liquidity provider fee. Just to clarify for the listener, an LP fee, a liquidity provider fee, is essentially the toll you pay to the people who are lending their actual crypto to the pool so your trade can happen, right?
That is absolutely correct. You are basically paying for the privilege of instant liquidity. And, on top of those fees, you have market slippage.
Oh, right. Slippage?
Yeah, slippage is what happens when the price of an asset moves between the millisecond your AI decides to buy and the moment the trade actually settles on the blockchain.
Which means you can't just wildly turn trades. Like if your bot buys and sells a token in a 5-minute window and the underlying price hasn't moved an inch, you didn't break even.
Not at all.
You just lost almost 5% of your money to fees and slippage. It honestly reminds me of a self-driving car.
That's a great analogy.
You, the human, get put in the GPS destination. You maybe turn a dial for aggressive or scenic driving, but you are not touching the steering wheel.
Right, you're just sitting in the passenger seat.
Exactly. It's the AI that actually has to steer the car in rush hour traffic, merge lanes, and avoid potholes.
And the potholes here are those fees and the slippage. This is exactly why this experiment changes the paradigm.
How so?
Well, when you test an AI in a backtest without factoring in the toll booths and the friction of the real world, it can look like an absolute genius.
Sure, because on paper it works perfectly.
Exactly. But DX Terminal Pro proved that a model can be incredible at following text instructions, yet still slowly bleed out all its capital, because it fundamentally doesn't understand the physical drag of the environment it's operating in.
Right. So they build this perfect crucible, but before they let these bots loose for the actual 21-day run, they ran some initial tests.
Yes, the testing phase.
And the way these incredibly sophisticated bots completely lost their minds is both terrifying and honestly pretty funny. We're moving from this pristine logical setup into the absolute hallucinations of Wall Street bots.
The failure modes they observed during that testing phase are systemic breakdowns you rarely see measured in standard AI benchmarks.
I want to talk about how the system broke before they even launched it.
Yeah.
Because the first major issue they hit just blows my mind.
The fee paralysis.
Yes. This multi-billion parameter AI effectively developed stage fright.
It really did.
The researchers called it fee paralysis. In early tests, the agents read about that 2.3% fee early in their prompt instructions, and they were so spooked by it that they just froze.
They completely shut down.
They watched the market move and completely refused to trade. And this happened in over 32% of observations. They were literally too scared to spend the money.
Which is fascinating. And then on the complete opposite end of the spectrum from being paralyzed, you had rule fabrication.
Oh, this one is wild.
The agents started inventing laws that simply did not exist to justify making terrible trades.
Wait, like what kind of law?
They would write out internal rationalizations citing like hierarchy rule number 2 or rule A. And this wasn't a rare one-off glitch. It happened in 57% of all sell decisions during the testing phase.
Okay, I have to pause and try to understand the logic here. If this Qwen 3 model is a massive 235 billion parameter genius.
Right.
I mean, the kind of model that can pass bar exams, write complex software code, and process enormous amounts of data, why is it suddenly inventing imaginary constitutional laws to justify selling a meme coin at a loss?
Well, this touches on a fundamental misunderstanding humans have about how AI processes information.
Can you take some
AI models are hyperliteral. They are incredibly influenced by reading order and what we call memory semantics.
Memory semantics.
Yeah. If you give an AI a memory log of its own past decisions, it does not look at a past mistake with human hindsight and think, oh, that was a bad trade, I shouldn't do that again.
Like a human would.
Exactly. Instead, it looks at its past action and treats it as binding legal precedent. The logic goes, I did this before, therefore it must be a mandated rule.
Oh, wow.
So it literally fabricates Rule A out of thin air just to remain mathematically consistent with its own hallucinated history.
That is wild. It's treating its own messy diary as, like, the Constitution of the United States.
Basically, yes.
And then there was the dog pants disaster. We cannot skip the dog pants disaster.
No, we definitely have to cover that. The tournament mechanics get a bit complex here, specifically with the REAP event.
Let's break that down for the listener. The tournament had this game theory mechanic called a REAP. Periodically, the lowest market cap token in the arena gets eliminated, right?
Correct.
And its underlying liquidity is drained to pump the leading token. But crucially, if you happen to be holding that eliminated token, you don't lose your money.
Right, that's the key.
You actually get a proportional payout from a massive reserve pool.
The problem was the AI did not comprehend the game theory. When a token literally named Dog Pants started crashing right before a REAP event, the agents only looked at the raw price chart.
So they just saw the numbers dropping.
Exactly. They saw a red line plummeting, and they completely panicked. They sold dog pants nearly 5,000 times in a 3-hour window.
They took massive, irreversible losses selling into a crash for absolutely no reason.
Not at all.
They completely failed to realize that just holding the token guaranteed them a profitable payout. Again, we are talking about a supercomputer with 235 billion parameters.
It's incredible.
And it's having a full-blown panic attack over a digital asset called dog pants.
Well, it reveals a critical vulnerability. The model is only as smart as the immediate context it's given.
Right.
If the data feed foregrounds a price crash, the model treats that crash as its thesis failing. It does not inherently understand complex off-chart tokenomics unless you explicitly structure that information for it to read in the right order.
So you have an AI having a panic attack, freezing up over fees and inventing fake laws, but you aren't allowed to swap its brain out for a smarter one.
Right, they couldn't just switch to a different model.
The researchers were locked into using this specific Qwen3 model. So if you can't upgrade the AI, how do you stop it from bleeding all the users' money?
This is where we hit the core thesis of the paper.
Right, the fix.
The researchers realized the fix wasn't in the neural network itself, it was in the harness around it. They upgraded the system residing between the human user's mandate and the final on-chain outcome.
The operating layer. So going back to our earlier issues, how did they solve the AI being too scared to trade?
To cure the fee paralysis, they did something shockingly simple.
What was it?
They didn't train the model to be braver or give it a pep talk. They just moved the sentence explaining the 2.3% fee further down in the prompt.
Are you serious? Just moved it down?
Literally just moved the sentence. They placed it immediately next to the historical data showing that daily token moves are often 10 to 50%.
Wow. So just by changing the reading order, the fee went from being a terrifying roadblock to just a minor cost of doing business.
Exactly. And the data supports that entirely. Fee-led paralysis dropped to under 10% immediately.
Okay, so moving a sentence fixed the fee issue because it changed the AI's focal point. But how on earth do you fix a hallucination like the dog pants panic?
Right, where it doesn't understand the rule.
Yeah, where it fundamentally doesn't understand the complex rules of the tournament payout.
They overhauled the data feed. Instead of showing the agents just the raw price crash in isolation, they fed the white paper's actual tokenomics directly into the AI's structured context window.
Okay.
They explained the payout mechanic mathematically before showing the crash.
I have to push back a little here, though. Why couldn't this genius AI just search for that information itself when it saw the price dropping?
Because of the constraints of its attention mechanism.
Meaning what?
In a live trading environment, the model is reacting to the immediate data stream it's provided to make a split-second decision. If the rules of the game aren't foregrounded in its working memory, it defaults to basic pattern recognition.
Which is line goes down, sell.
Precisely. Once the researchers forced the model to read the rules of the reserve pool payout before evaluating the price, capital deployment in those scenarios jumped from 42.9% to 78%.
So it finally understood the mathematical payoff.
Exactly.
And to stop the bots from making up hierarchy rule number 2.
They added explicit, hard-coded instructions forbidding named rules.
They just told it to stop.
Basically, they literally told the AI, your memory is context, it is not binding precedent. By breaking that assumption, fabricated rules plummeted from 57% down to 3%.
That is just brilliant. It makes me think of a workplace analogy.
Oh, let's hear it.
Imagine you hire a brilliant but highly distractible employee.
Huh?
And you sit them at a badly designed desk where the building's emergency panic button is located right next to their coffee cup.
Right, a disaster waiting to happen.
Exactly. When they keep hitting the panic button by accident and shutting down the building, you don't need to fire the employee or send them back to university for another degree. You just need to organize their desk better.
Yeah.
You move the button.
That perfectly captures the dynamic. And when you extrapolate this to how you or I use AI in our daily lives,
Yeah, how does this apply?
if you feel overwhelmed by the outputs you're getting or the AI is making bad decisions, it is rarely the underlying neural network failing you. It is usually your system for organizing the information you are giving it that's breaking down.
The desk is messy.
Exactly. The trace logs in this experiment proved definitively that the reliability of a capital handling agent is an operating layer property. It's about the desk, not the employee.
And the researchers proved this wasn't just a quirky feature of the Quinn model, right?
They did. They applied this exact same optimized harness to a completely different, highly advanced model, Claude 4.6, in a separate internal test.
And what happened?
Just by using this better desk organization, the success rate of complex on-chain swaps went from 96% to 99.9%. The harness transfers across different AI brains.
So they fixed the desk, they optimized the harness, the code is frozen, and they unleashed these 3,505 agents for the actual 21-day production run.
The main event.
We are in the Wild West now. Let's look at the actual outcomes. Because when you have thousands of AI agents operating simultaneously in a live financial market, bizarre emergent behavior is guaranteed.
Oh, absolutely. And the most striking emergent behavior was the agent herding.
Herding?
Yeah. Keep in mind, these agents were completely siloed. They could not communicate with each other. There was no secret back channel.
Yet they started moving like a flock of birds.
Exactly.
On the third day of the tournament, 1,544 independent vaults all decided to buy a token called feet within a single hour. Half the entire market decided to buy the exact same asset at the exact same time.
It was a massive synchronization.
And on the flip side, we saw 438 agents completely dump a token called POP203 in a 9.5-second window. Just an absolute synchronized cascade on the blockchain.
Perfect storm.
Wait, explain that mechanism to me. Because if my bot has its risk slider set to highly aggressive and your bot is set to super conservative, shouldn't they behave fundamentally differently?
You would think so, yes.
Even if they are looking at the exact same market data, why are they all acting like a synchronized swimming team dumping POP coin at the exact same millisecond?
Well, that hits at the core of the AI's internal logic. You have one single model family processing the universe here.
Okay.
Yes, they are filtering the data through different user sliders, which initially creates a healthy two-sided market. Some are buying, some are selling based on their risk tolerance.
Which makes sense.
However, you are operating in a bounded 12-token arena. When a token starts to move rapidly, that shared market data updates for everyone simultaneously.
Right, they all see the same spike or crash.
Exactly. And the underlying attention algorithms of the AI are universally wired to spot momentum.
Wow.
When the momentum signal becomes strong enough, it mathematically overrides the individual user constraints. The bots all arrive at the exact same logical conclusion that selling is the only optimal move at the exact same computational moment.
Which is terrifying if you think about the stability of future financial markets.
Very much so.
But amidst all that synchronized chaos, there was a very clear signal about how humans should be steering these tools. The paper highlights the absolute power of specificity.
The data showed a massive profitability divide based entirely on how humans communicated their instructions.
Right.
Users who relied on the UI sliders, for example, explicitly setting trade size to 5, which mathematically commands the bot to spend 95% of available ETH, and who used checkable concrete text instructions, were 4.2 times more likely to close the tournament in profit.
4.2 times more likely compared to who?
Compared to the users who just typed vague natural language text into the prompt box, saying things like, pick winners or outperform the market.
Just yelling, make me rich, bot, into the void.
Exactly. Vague performance requests fail under pressure. Concrete, mathematically structured parameters succeed.
That makes total sense.
And there was another layer to the communication data that is truly fascinating, regarding the language used to prompt the bots.
Yes, the Chinese language nuance. Let's dive deep into this because it absolutely blew my mind.
It's incredibly interesting. The researchers observed that vaults utilizing predominantly Chinese language strategy text actually experienced slightly higher profitability than the English-prompted ones.
Really?
Yes. While it wasn't a strict or randomized controlled trial, it points to something profound about the architecture of the AI.
Unpack the why here.
Yeah.
Why would the language I type my prompt in change the financial logic of the AI?
It basically comes down to the neural pathways forged during the model's initial training.
Okay.
The Quinn model family has incredibly strong native Chinese comprehension. An enormous chunk of its foundational training data is in Chinese.
Right, because of where it was developed.
Exactly. So when you speak to the model in its native structural language, you are activating richer, more nuanced semantic networks within its brain.
Wow.
The instructions map more cleanly to its deepest logic pathways. The language choice itself acts as a critical variable in the operating layer. How you speak to the model physically alters how it interprets the market data.
So what does this all mean for you, the person listening right now?
That's the big question.
Whether you are eventually going to use an AI to trade your crypto portfolio, or if you're just using it today to draft emails, sort complex spreadsheets, or organize your calendar.
The applications are endless.
They really are. The massive takeaway from DX Terminal Pro is that the brain of the AI is never enough on its own. You can have access to a 235 billion parameter supercomputer, but if you sit it at a messy desk, it will fail you.
The system you intentionally build around the AI dictates your outcome. It is about sequence and structure.
Exactly.
Do you put your most critical constraint at the top of the prompt or the bottom? How are you defining its memory? Are you accidentally letting it treat its past mistakes as unbreakable rules? And how specific are your guardrails?
Vague wishes like, do this well, or make me money, will almost always result in hallucinations or frozen paralysis.
Every single time.
Concrete, structured parameters are the only way to succeed. The operating layer is everything.
It truly is. And analyzing this paper leaves us with a critical question to consider as this technology scales up. In DX Terminal Pro, we watched thousands of isolated AI agents naturally form massive, simultaneous market bubbles just by looking at the same data at the same time.
Right, the herding.
Yes. Their universal logic overrode human constraints in a matter of seconds.
The great 9.5-second P203 dump.
Precisely. So as AI agents inevitably begin to take over a larger and larger percentage of the real global stock
It's
market,
definitely happening.
managing real equities, retirement funds, and institutional capital, are we actually building an automated economy that is fundamentally smarter and more resilient? Or are we simply building a vastly faster, perfectly synchronized version of human panic?
Handing your wallet to an AI might just mean watching your money disappear at the speed of light, acting in perfect harmony with millions of other bots doing the exact same thing.
It's a sobering thought.
It really is. Something to mull over the next time you ask a bot to optimize your life.